So the thing with why I keep bringing up Cem Karsan is that he's been nailing market structure. I mean, the way he uses options flows in order to provide um, an analysis of where price should go and what thing might lead to another thing. This path dependence for price. To me is a type of magic. I wish I had the time and resources that he had, because he spent years as working for dealers, options dealers. So he has some idea of how the decisions are being made and some of the requirements that they have. I mean, he's not the only one; other people are as well. But to be able to talk about the types of events that might occur down the line, I thought were fantastic. So I actually just wanted to play this video for you and just to get your initial feedback on it. This is actually an interview he did. This is July 18th. And he had been talking about the idea that there's these periods where the dealers need to actually manage the positions, or they need to unwind. There's all these dynamics that happen automatically, that there's these forced buyers and sellers within the markets. And so he's just touching on that a little bit as he's talking about this idea.
We talked about dispersion a couple months ago. It's been 2 months, and we talked about the supportive flows. This summer of George, right?
Right.
Until Wednesday, that was the game for 2 months, right? What was Wednesday? It was Vixpiration. People who've been following us for a while know Vixpiration is the opening of the window of weakness. We haven't talked about July opening. We talked more about August and us getting through the summer. That's a window of weakness. Importantly, the vol trade is central to this whole operation, right? What do I mean? The vol supply at the index level is what's caused this historic dispersion. And the short gamma in Nvidia and a couple of these other names was forcing a two-directional move, right? Because the index is pinned and one of the parts of the market is squeezing, the other part has to go the other direction. Now, the other side of this trade is if people are long calls or long gamma and the dealers are short it, if that momentum can even slow a little bit, which it started to about a week and a half ago, that starts making dealers who are now short those calls and long stock they're short gamma. They have to sell that VANA, they have to sell those deltas. And so we started to see the weakness. And it wasn't strong weakness, it was just consistent selling in those names. But it opened the door for the weakness now that we're seeing. And all it took was a little macro comment by Trump, right? We talked about this several weeks ago. The fragility that's been created in this market by taking a name like Nvidia, which in 22 was left for dead despite all of the AI truths about it, because of the fears of an invasion of Taiwan. People did not want to invest in Nvidia because it was considered somewhat uninvestable because of the existential risk. Nothing has changed there. I would argue that we're marching towards a higher probability of that happening as we move forward.
Geopolitical issues?
Geopolitical issues. And to be clear, that's an existential risk to what was the biggest company in the world.
You think this is why we're getting hit in the last 48 hours particularly?
It's a combination of, it can drive a narrative change, which is important, but it's hitting Nvidia right at that moment when those calls are decaying and that momentum is waning.
Okay.
So this is what I find so fascinating about it. So he talks about this idea of that there's periods in the markets. There are periods in the markets where volatility is not well supplied, or it is well supplied. And so if vol is well supplied, which is to say that the market participants are hedged appropriately, well, then it makes a drop less likely, because they're able to monetize their hedges and then not suffer the drawdowns that would make them forced sellers. And then because of that, the volatility is low, and so the dealers don't have to overly buy or overly sell. You get this steady sideways or upward drift to the market. But in these periods where these hedges expire, right, these options expire, well, then there's a window before they buy them back at the beginning of the next month where there's this weakness. Vol is not well supplied. And then if an event happens around that time, some sort of catalyst happens, well, then it could get exacerbated because now people are scrambling in order to either sell the assets or to buy their hedges at exactly the time where they need it. So these options are going to cost more and all that sort of thing. And so I just love this idea that I love this idea of seeing the market as like I see it as soft, like flexible or inflexible. And that in the periods of inflexibility, since you can plan those, well, that's the time you want to buy options, and they'll be the cheapest right before that period. And you only have to buy it for a short period of time, as opposed to having to buy options every month or roll whatever. You can just buy it for 1 week or a 2 week period, and then and you could also know, because the other side of the options is when you sell it, well, it's not going to, if it's going to last at all, it's not going to last that much further past the next window where bullish flows come back into the market. So you have like 1 week, 2 weeks, and I just love this way of thinking about markets. Had you
Yeah.
ever heard about anything like this before?
Yeah, I've watched a lot of Kem's content as well. I mean, I'm very familiar with his view on markets, and he's definitely the type that is well spoken on the subject. The tough part, at least for our approach to some of the tools that we use, is that not a lot of this data is available to us in TradingView yet. Presumably, some of it might become available, and then we can build some really interesting models. The options data that I'm able to pull out of Quant Connect is also somewhat limited. I've got to do a lot of math on my own in order to figure out some of this stuff. So it hasn't been an area where I've spent an enormous amount of time trying to analyze the market from the options perspective, but I definitely see how the options market is evolving and modernizing and becoming a more critical component to where a trend starts to show up and where events start to take place. And so there's no question it should be something we pay attention to.
What about because I've been you're right, we don't have access to the options data in TradingView, but these periods of quarterly expirations,
Mhm.
these are known ahead of time. So I just pay attention to the calendar for it, and then
Mhm.
I know that there's certain periods of time where I'm looking for weakness happens, some sort of catalyst happens, a pullback in price, and then I know now I can execute my strategy. Like I have certain strategies that require me being essentially at the bottom. Like my price better never come now lower than this entry point,
Mm.
because I'm doing some obscene amount of leverage. And before I was guessing, when I might be able to get in. But now with these windows, I go, okay, Bitcoin. If I got a 15% pullback, well, now I know I could take maybe 3 stabs at grabbing the bottom, because chances are we're at the end of month end, the beginning of next month. Let's say the third of the following month. There's not a lot of expectation that the downward movement should continue, and then
Got it.
oftentimes I'll get this squeeze back up because the flows are actually back in, and then we see
Mm.
it in liquidity and all that, like we've talked about before.
Mhm.
Super fascinating to me. It also makes me like I find it very difficult to trade a spot or a futures on um, traditional assets versus the options on them, because you get uh, I get all the benefit of the upside without having to actually hold the stock, or having to put as much capital on. And if I'm expecting these bullish flows because of the liquidity cycle that I'm in, well, then every major drop, once you get to a certain period of the calendar, should you know you're encouraged to buy calls on that, because chances are they're gonna pay off. And buying those calls exactly at the period where the drop happened, the panic, Nvidia falls drastically. People go, "Oh my god!" Now they're talking about levels so much further down; it's just going to fall precipitously. And you go, "Okay, well then now's the time for me to buy calls on there right near the end of the month, because if it's going to pay off, it'll pay off fantastically, and it won't even cost that much because everyone's on the put side." Uh, to me, it feels like seeing other people's cards as you're playing poker. That's the sense that I get.
That's a rare opportunity then. I think, and I know we've discussed this before too. One of the interesting things about the options market is there's just a lot more information about market participants than you'll find in other asset classes. Where we typically only really have the number of shares traded or the number of contracts traded. So we've got some volume information. Maybe there's some depth of market with the order books we can kind of take a look at. We can watch that as it changes. But the options market has a whole lot more information that's baked in than other asset classes.